Hello and welcome to Commodity Culture, where we break down the commodities space for both new and experienced investors. My name is Jesse Day, and before we get started, standard disclaimer, nothing here is investment advice. Do your own due diligence. And this episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JESSEDAY to get a $10 discount on your first purchase. Today's guest is the founder of the Independent Speculator with a track record of winning recommendations and extraordinary overall gains. It's somebody I always enjoy talking to. Mr. Lobo Tiggre, welcome back to the show.
Thank you very much. And it's kind of you to mention the track record, but I think of myself as a due diligence guy. People hire me. If they can't go kick the rocks, that's what they hire me to do on their behalf via the newsletters. So I like to hear you start your podcast with the due diligence reminder.
Yes, absolutely. And you are one of the most level-headed analysts out there. So that's why I always appreciate talking to you, completely free of hyperbole. And I want to get started with uranium here, because the spot price of uranium has experienced a nice upswing, with the equities following suit before pulling back somewhat. This actually caused some people to complain on uranium Twitter, which blows my mind. So maybe you could explain to us why corrections are a normal and healthy part of market activity.
Well, you shouldn't need me to do that, but corrections are a normal, and so it's called a correction. That's exactly right. But it's interesting that you say that. The response that I've seen in the Twitterverse has mostly been, are we there yet? Like, is this the opportunity? Because I've been warning people, earlier this year when everybody was whining about uranium doing nothing, it's just sitting there. Come on, even tin is giving commodities speculators a better ride than uranium. What's wrong with uranium? Oh, it hasn't done anything for months. Like, months is a long time in the commodity space. But anyway, so I said, in a rare move for me, because I hate the prediction racket, I said, no, this is happening, and I think it's happening this year. And here we are. So if I'm about to rain on the parade, remember that I'm not a perma bear, right? I was out there with Justin Hune and a few others pounding the table saying, no, this is really happening. So, and now, so give us credit for that. So yes, just forget my track record. Look at uranium's track record. For the last 5 years or so, it's been a 2 steps forward, 1 step back, sawtooth pattern. It's a very strong upward trend. So, whether you think of it as healthy or not, it certainly is normal in this specific market and this specific bull trend that we're in for us to see a correction like this. And it's been so not exactly regular, but it has happened so consistently that when uranium went vertical last month, I told people, hey, this is great. If you've got profits, think about taking some money or at least some risk off the table. But if you're looking to buy, wait for the next correction. And people will say, when? And I said, well, I don't know. Of course, nobody knows the future. But A, it happens, 2 steps forward, 1 step back. And B, we've got an economy, a global economy that's clearly going into recession. And I think the US is going into recession as well. And that always whacks the the energy sector. And even though you and I and our audience probably understands that uranium provides baseload power, it's more recession resistant than oil. You might not decide to drive to go visit grandma every weekend when gas prices are high, but you do want the lights to come on every time you flip the switch. So we get that, but it's just one of those things, recession, sell energy. It happens every time. And if that's, maybe I'm wrong, maybe team soft landing is right. And somehow the unbroken track record of the inverted yield curve and disinversion is going to break this time. This time it's different, right? But if the yield curve is right and I'm right, we're going to see recession in the United States, and that the odds are strong that would whack all energy commodities, including uranium, which it shouldn't. And we have also, I'm going long on this, but another key thing to remember is uranium stocks are stocks. And we have seen days when the spot price of uranium has risen and the stocks have fallen because Wall Street was having a bad day. Now, on a daily basis, we can see this. On a pullback monthly or yearly basis, the stocks will follow the uranium price. They don't ignore the uranium price for long, but it does happen. So even if you're very bullish on uranium, it still makes sense to let volatility be your friend here. The market has shown us what it's likely to do. And I think this bit of a correction that we have now is a godsend to anybody who missed it. To answer the question, is it time to buy yet? Is this the dip, Lobo? Is this what you were telling us to buy? I think anybody who's long already, I would actually say no, especially the recession denial hasn't given way yet. I think there is probably more downside. It's not much of a step back yet that we've had. Now, if I was brand new to the sector, though, I had no uranium stocks and I felt like I had missed the boat, that'd be different. I'd be willing to nibble, judiciously on a small initial take with the understanding that if it goes on sale further, that I'll be happy to buy and average down. But that way, at least I have my finger in the pie, foot in the door, whatever metaphor you want. And if, Sput 2.0 comes along or the Kazaki vehicle starts buying things out, who knows? Any number of things could send uranium vertical. Oh, Russia could decide to say, you know what? We're not exporting any more enriched uranium. There's factors that could happen overnight here, almost like that other yellow metal that you just don't, a day late can be way too late on this. So I would want to have a finger in the pie here if I didn't already. But if I did, the odds favor better buying opportunities in the weeks ahead.
That makes a lot of sense. I want to shift from uranium to the long-term treasury market because it's taken quite a beating over the last couple of weeks. If we look at the TLT ETF, it's been dropping precipitously. Is this just normal market volatility in your view, or could it herald something more significant in the overall economy?
Well, here I'll have to defer to the bond kings of the world. I'm not one of those, and I can't say that I've made a lifelong study of the bond market. Clearly, it's quite significant. Even the mainstream cheerleaders on financial media that are, thoroughly on board with Team Soft Landing, even those people, they're like, yeah, this is pretty concerning. We haven't seen this before. So, disinversion as you get close to a recession is normal. That's the signal. Inversion says it's coming. Disinversion says it's imminent. And everybody knows this, right? Even if they dismiss it or somehow convince themselves this time is different, people know this. And so to see the disinversion to affect the long end of the curve, that's quite alarming. I mean, that sends a heck of a signal to say that, if people think the Fed is beating inflation, why the heck would that affect a 30-year bond? So I'll just leave it at that. It strikes me as significant. I think it's alarming. I think it's a signal that's tweaking the mainstream even, and we'll see what kind of impact it has. But I'm already in Team Hard Landing. So for me, it's not a wake-up call.
Well, we are seeing another war emerge, or potential war, depending on how you want to look at it, between Palestine and Israel. You mentioned that if this expands into a regional conflict, that it could affect the price of oil and gold. Could you walk us through how a war in that region could have an impact on the oil and gold markets?
Well, that's not a guru call on my part. That's pretty obvious and almost self-evident. But first, I would say this isn't just old Lobo, spouting ideas. I mean, it happened. We saw it Sunday night. The moment futures trading started, gold spiked, oil spiked, the major indices in U.S. stocks went in the red. So that was a classic knee-jerk reaction to geopolitical risk flaring up like this. So this is well established. It's well understood. Why gold, why oil? Somewhat related, but somewhat different. Gold just as a safe haven asset. And the price, all right, let me come back to that. Price movement hasn't been too big, but let me come back to that. For oil, it's the Middle East. It's where oil comes from. So, okay, Israel is not a huge oil producer. They have actually entered into the offshore gas business, and they are a player there. But it's not Saudi Arabia, right? And it's probably never going to be. But it's close. It's in the area, and it's surrounded by countries that are oil producers. And if they get drawn in to another 7-day war or some larger conflict, that would be very bad. And hopefully that won't happen. Even though I have oil bets that would benefit, I don't want to profit that way. I would love for this to be contained and quickly subside and become, a fight against terrorism rather than an actual war. Now, Hamas has called for allies and friends to come to its side. So far, only Hezbollah seems to be even tempted, and even that on a limited scale. And Hezbollah is not a sovereign, so it's not like, say, Jordan or Iran deciding to come in on the side of Hamas. That's what I mean by, being really concerned about regional escalation. And if that happens, triple-digit oil prices, here we go. I mean, just like that, I think. Now, other thing to always remember about geopolitical risk for both of these is these flare-ups tend to have temporary impacts on commodities prices. Unless you had an absolute game changer, that something that destroyed a significant amount of supply, what happens is you see a big surge during the outbreak, and then the price reverts to trend. And if the trend was downwards, the price will go lower. If the trend was upwards, I'm sounding like a TA here, but this isn't, voodoo line drawing on. It's just a simple observation. You get these big spikes, and then it goes back to the trend that was following before. So despite oil's recent correction, I think the bigger picture for oil is upward, and I think we do see higher oil prices ahead. This is just a reminder. But if there was a time machine where we could bet on this happening before it happened, great. But that's not the case. Similarly for gold, we've seen this when war outbreaks. Gold will react, but then it'll revert to mean. So, it's nice if you're long already. It's probably too late to act now unless the conflict does spill over. But it's been a couple of days now, and no sovereign in the region, no Arab sovereign in the region has said, "Oh yes, we're coming to Hamas's aid. We're sending our military in." So I would not bet on that escalation now. It's a risk, but it's certainly not the highest probability that I can see. And for humankind's sake, that's a good thing. As a commodity speculator, I think it pays right now to look at the longer trend and not get too excited about this. But hopefully will be a flash in the pan.
Let's shift over to copper now, because the International Copper Study Group has stated that the copper market will shift into a major supply surplus in 2024. This seems to run contrary to a lot of the news and other reports, S&P Global being one of the organizations that put out some research saying that there will be an unprecedented supply deficit for copper up ahead. So what's your take on the findings of the ICSG report?
Well, yeah, it's all in the model, right? Every time something like this crops up, I think about that Monty Python movie, not Life of Brian, Holy Grail, when they go to Camelot, and then they say, "Oh, it's only a model," right? It's breaking the fourth wall. It's only a model. Oh, on second thought, let's not go there. So, your model, it's garbage in, garbage out. It depends on your assumptions. You could actually have identical models and vastly different results depending on what you feed the model. So, when it comes to mining, I think a lot of these projections tend to be optimistic on the supply side. Like they will go and they'll look at all mines in the given commodity that are under construction today, right? Or the ones that are under construction and planned, or have a definitive feasibility study, so that's close to a construction decision. But many companies have a feasibility study and they never build the mine, or they can't raise the money. Or, they think their feasibility study is great, but the market doesn't want to fund it, right? So again, depending on the assumptions, there can be a lot of garbage into those models. And even if it's under construction, we're seeing cost blowouts, we're seeing delays, we're seeing all kinds of problems in the endeavor of mine building these days. So the problem with adjusting for that is it becomes suggestive. Subjective. There's no way you can precisely model how long the delays will be on X, Y, or Z copper project. And if it's a multi-year build and it's delayed by 25%, that could be a whole nother year. That could entirely throw off your projection for 2024 if it's a big source of new supply. So, not to beat this to death, all I'm saying is I understand why they have to look at the data they have. And the data they have is here's the mines under construction or here's the ones on the horizon. But the actual delivery by the companies building these mines is subject to long and variable lags. So I tend to see most of these models as overly optimistic. And the other thing about this particular one, the study, is that, like me, they are assuming an economic downturn. But my view is that when that economic downturn becomes undeniable and people, voters, start complaining, then the powers that be step in again and throw a bunch of money at the problem. So, that economic downturn could turn into a reflationary boom in short order if somebody thinks they're going to lose an election. So all I'm saying is take it with a grain of salt. I think it's premature to, well, you never really know. But I think given the probabilities I see ahead, I think we might see some excess in the early part of 2024, but I don't think that would last long. And it certainly doesn't change the big picture. In some ways, if they're right, and I'm overly cautious here, that would be the best of all worlds for the potential copper speculator out there. Because if they're right, and there's a notable surplus next year, and prices go down, does nothing about the long-term, structural supply constraints that we're facing, even without the electrification agenda, but with it, even more so. So, if I'm wrong and things are fine, but there's no big meltdown, there's no big government push of money, whatever, just the world muddles along and there's a bit of surplus next year, I would see that as a tremendous buying opportunity.
Germany is going to reactivate several coal-fired units for the winter. This, combined with both India and China announcing massive expansions to their coal build-out, has me thinking that maybe there's some opportunity here in one of the most hated sectors in commodities. I know this isn't a commodity that you generally cover, but do you have any thoughts on thermal coal at the moment?
Well, no, I cover them all. I'm just bearish. People don't want to hear it. Though you're not the first to ask me about this recently, because coal prices have actually done well recently, and gotten a lot of attention. So I can understand that. And if something that you thought you could do without, suddenly you discover you need it again after all, there's good narrative to go with the price action here that makes coal more interesting. And, that's possible. But the things to keep in mind is that coal is a regional market, or it is a collection of regional markets. We quote the price of coal. But if you're, mining the stuff in Australia, you're not sending it to Germany. If you're mining it in Canada, you're right. So the markets tend to be regional. And then, which company can benefit from that particular region's supply and deficit balance. It's a trickier commodity. It's not like gold that you can just stick on an airplane. You can fly it out of your mind and it will pay for itself because it's that valuable. Or even oil that you can ship pretty easily. I mean, coal is such a bulk commodity that you need the right pieces nearby to work out. Now, so if the macro works out, if the macro sends coal prices higher, the rising tide will lift most ships. Okay. But who knows how high, who knows how long, and maybe some not at all. Whereas if you've done your due diligence, you've picked the right company in the right market and they benefit, they are the ones who are going to supply these power plants that Germany's going to bring online because they don't have any nuclear reactors they could bring back online. Then maybe you profit, but that's a much bigger task, and it requires much more due diligence and effort than just, oh, I like coal. Coal was starved for capital, so coal prices are going up.
That's a very good point about the regional aspect. I actually hadn't thought too deeply about that. Not as easy to transport around the world as many other commodities. I wanted to switch to a story that's been making headlines recently and get your take. Is this just media hyperbole? Does this mean anything? And that is Costco apparently starting to sell. Well, they are selling gold bars, but they're apparently flying off the shelves. Is this just another media headline that's getting spread around for clicks? Or could it actually be an indicator that sentiment in fiat money is dwindling and more people are looking for a safe haven in uncertain economic times?
No, no, yes, no, I guess are my answers. I mean, it is happening. The CEO did say in an interview that they are, they're selling out when they can get it, the product, they're selling out. And I don't think he would just make that up or whatever. I mean, that's it's a publicly traded company. He get in big trouble for making stuff up like that, and there's no particular reason for him to do it. So I do think it is happening, but I'm not convinced that it's indicative. Like, is this the masses rising up? That the great majority, the silent majority, is bitten by gold fever, and they're all going to become dyed in the wool gold bugs. No, I think that's a bit premature. Remember that if you're a Costco member and you have one of these Costco cards, you get cash back on your purchases. So even though the prices I saw quoted were like any other vendor, they're above spot. But if you have various Costco perks and you get cash back on your purchases, that actually refunds a fair amount of that premium. So if you can buy gold bars at Costco at much closer to spot, and depending on your perks, possibly even below spot, depending on how spot is moved, right? If you can buy gold relatively cheap or with minimum premium compared to other sources, then that's a deal. And so it strikes me like, any Costco deal, if they can deal in bulk and get people a good price, then they'll move a ton of whatever it is. It would take more than just this to convince me that this is a sign of a mass movement. I mean, I was just a kid. I was a lawnmower guy in the great bull market of the 70s, but I remember it. I remember everybody talking about it. Okay, I wasn't the guy with the shoe shine boy telling me about the stocks he was buying, and I wasn't old enough to go into a bar to hear the bartender tell me about the gold he was buying or whatever. But I remember the buzz, and gold and silver. And I was putting my lawnmower money into silver because my friends were doing it. The smart people that I knew, everybody, were scavenging silver, dumpster diving for silver connections and contacts and things. I remember how this was a meme, may not be the right word, but it was a fad. In 1979, it was a fad that everybody knew about, was talking about, was aware of, at least even if they didn't participate. It's nothing like that. So this Costco story, it's gratifying, it's nice to see, but no, I'm not breaking out the champagne on that basis yet.
You've stated in your newsletter that at the moment, uranium has been the only commodity that you've been actively looking to invest in. I was wondering what your thoughts are on the gold equities here, because we've seen the price of gold drop. Gold equities, especially in the junior mining space, have looked to be cheap for a while now. Are you still holding off on gold stocks? And if so, what are the headwinds you see that make you want to sit on the sidelines for the time being?
Yes, and for all the people who are going to fire off hate mail, remember that at least I was right about this. I've been warning since this summer that the tail headwinds of higher for longer, which is happening, right? Gold doesn't pay interest, and in a high, relatively high interest rate environment, certainly compared to zero, where we've been for so long, that's a major headwind for gold. My research indicates that the historical relationship between gold and interest rates, real rates, nominal rates, both, has been changing. And I think that has to do with government interference in the markets. And I don't mean necessarily manipulation. I just mean, like, when you nail rates to zero for so long, there's no price information there. There's no price discovery there. But still, rate interest, when people can get what they think is risk-free yield, Like they can buy, even on the shorter end of the curve, they can buy 2 years or 10 years looking at close to 5%, right? People think that's risk free. That's a safe haven asset to the mainstream, like gold, right? It's as good as gold, but it pays interest. So that is a huge headwind for gold. And then there's the perception, increasingly strong over this year until very recently. Now maybe it comes and goes, but the perception that team soft landing is right, that the Fed is miraculously threading the eye of the needle, and that we can have inflation come under control without creating more unemployment or breaking the economy. The official employment numbers make it look like team soft landing is right. That's terrible for safe haven assets. If anything, I've been surprised that gold has held up as well as it has. And the proximal cause or answer for that seems to be central bank buying, but that's a fickle friend, and there was less of that in August. So even if central banks continue to buy over the years ahead, or more of them as the de-dollarization trend continues, you can't count on that this month or this quarter. And perhaps that's why we've seen some fluctuations there, and that could be why gold is finally feeling these headwinds more than it was a month ago or two. But anyway, to answer the question, no, I'm not ready to buy yet. Yes, I'm as bullish as ever. I think we're looking at new nominal all-time highs in gold before too long. And I'll go out on a limb and say within the next couple of quarters, I could even see it happening by the end of this year if the Fed really does break something else. And there is a pivot that nobody's expecting. And eventually even real all-time highs in the gold dollar exchange ratio going forward as the consequence of all the fiscal, don't forget fiscal, and monetary policy works its way through the economy. But right now, these headwinds are still there. The reasons that I said gold was likely to retreat, they're still at play. And okay, a convenient war may make the price spike up. And I'm not trying to make light of the suffering over there, but I'm talking to the gold bugs out there. Don't confuse this temporary surge on news of war with something fundamental in the market having changed. And don't confuse the long-term fundamentals of all the money printing. Milton Friedman will be right, as he always is in the end. But right now, higher for longer, team soft landings, apparent victory, these are serious headwinds for gold, and those haven't changed. Until that changes, or the Fed really does break the next something, right? Or if CPI and PCE start heading more strongly upwards, and if the core numbers start heading up again, then we'll see some action here. But so I have things I'm watching for. It's not just I don't claim to be able to time the bottom. You know me, Jesse. I'm never going to make a prediction like that. Oh yes, on October 17th, well, that's when the bottom will be in for gold. No, nobody knows that. But there are triggers to watch for. When people start having those holy beep moments, and team soft landings credibility goes down the drain, that's material. We'll see.
Well, thank you so much for joining us today, Lobo. It's always a very enlightening conversation when I get you on. Before I let you go, for those who want to learn more, tell us about the Independent Speculator. I can say personally, I'm a subscriber to the free version, and it is fantastic. I think it's the best free newsletter out there. So I'll set you up with that to begin with, but tell us about it.
Well, thank you, and you're very kind to say those things, particularly since I'm the rain on the parade. you say level-headed, but nobody wants level-headed. They want somebody to convince them that they're right and they're going to make so much money tomorrow. But anyway, yeah. So if you want some rain on your parade, if you want level-headed coverage, then I'm your due diligence guy. And the one thing I would say is if you subscribe to this free letter, it's called the Speculator's Digest. It is free, and you will not get a flood of spam. We don't send daily advertisements from all our sponsors or friends or stocks we own. You get one email per week. And if you like the way I think and write, maybe you can hire me as your due diligence guy through one of my paid publications. But if not, there's value to me in having that audience there. So please sign up.
Great. Well, I'll put a link to that in the description below. And thank you once again, Lobo, for joining us and sharing your knowledge with the audience.
Thank you, Jesse.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Link is in the description below. Use coupon code JesseDay to get $10 off your first purchase, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.